$735,000. That's the average new home loan in Australia right now, up $75,000 in just 12 months. Over 30 years, at today's rates, you'll hand the bank back $1.59 million. You've heard a number like that before. It's not the interesting part. The interesting part is that almost no Australian ever reaches the point in their loan where they're properly buying the house. Most people restart the climb before they get there, and no one ever explains why. By the end of this, you'll know 3 things you can check on your own loan tonight. One of them takes a 5-minute phone call and could be worth more than $180,000.
Here's the picture almost everyone carries in their head. 30 years, the same payment every month. The debt stepping down evenly until one day it's gone. At today's average variable rate of around 6%, that payment is $4,407 a month. It leaves your account on the same day every month for 3 decades. The payment really is the same every month, but the staircase isn't real. What's actually happening underneath is a completely different shape, and it's the reason your balance feels stuck for years.
Let's follow one single payment, the very first one. Of that $4,407, $3,675 goes to interest. $732 actually reduces what you owe. That's it. 83% of your first repayment doesn't buy you anything at all. Here's the way to think about it. The bank isn't really selling you a house. The bank is renting you money, and the house is just the security. In the early years, you're a tenant of the loan, not an owner of the home. And this isn't a trick, it's arithmetic. Interest is charged on what's left. At the start, almost everything is left, so almost everything you pay is interest. As the balance falls, the interest falls with it, and more of your payment starts landing on the debt itself. Which means every repayment slowly changes character. The dollar amount never moves. What that dollar buys you changes completely.
So there's a specific moment in every mortgage, the moment when more of your payment goes to the house than to the bank, the crossover. On the average Australian loan today, that crossover lands 18 and a half years in. 18 and a half years. That's not the halfway point of the loan. It's nearly 2/3 of the way through. Until then, the bank is the main beneficiary of every single payment you make. And look at the left side of this chart, because this is where most Australians actually live. 5 years in, you paid $264,000. Your loan has gone down by 7%. $250,000, and 93% of the debt is still standing.
Now, here's the part that makes the whole thing worse, and it's the part that almost never gets said out loud. The average Australian home loan only lasts about 4 to 5 years. People sell, people move, and above all, people refinance. Refinancing is at record levels right now. And when you refinance, the new loan almost always comes with a fresh 30-year term, which means you slide right back to the steepest, most interest-heavy part of the curve. The 5 years you just spent grinding through the worst of it, that progress on the shape is gone. You start the climb again. Do that twice in a decade, and you can spend 15 years paying a mortgage while never once getting near the crossover. I want to be fair here. Refinancing is usually still the right move. A lower rate is real money, and if you're on an uncompetitive rate, you should absolutely be shopping around. The point isn't that refinancing is bad. The point is that it has a hidden second price tag, and the bank has no reason to mention it. So what actually moves this? 3 things. All free, all checkable tonight. Number 1, and this is the big one,
There are 12 months in a year, but 26 fortnights. So if you pay exactly half your monthly repayment every fortnight, you make 26 half payments. That's 13 monthly payments a year, not 12. One extra payment every year that lands entirely on the principal. On the average loan, that one change saves over $180,000 in interest and cuts 5.5 years off the mortgage. You barely feel it because it hides inside the calendar. But, and this is the bit that matters, it only works if the arithmetic is done the right way. Some Australian lenders calculate your fortnightly repayment as your annual total divided by 26. If they do that, you're paying exactly the same amount per year that you were before. Same money, different days. The saving is zero.
So here's your 5-minute phone call. Ask your lender one question in these words. Is my fortnightly repayment calculated as my monthly repayment divided by 2? If the answer is yes, you're getting the benefit. If it's no, you're not. And you can usually fix it by setting up the extra amount yourself. Same question, one sentence. That's the whole thing. Number 2. When you refinance, ask to keep your remaining term instead of taking a fresh 30 years. If you've got 25 years left, ask for a 25-year loan. Your repayment will be a little higher because you're paying the same debt over less time, but you keep the ground you've already covered. Almost nobody asks for this, and lenders very rarely offer it. Number 3. An offset account. Money sitting in it is subtracted from your loan balance before interest is calculated. $50,000 parked in an offset saves around $210,000 in interest over the life of the loan. And you can still take the money out whenever you want. One caution. A real offset is a separate transaction account. It isn't the same as redraw, where you've paid extra into the loan and can.
So here's the thing worth taking away. Your mortgage isn't 30 flat years. It's a curve. And where you sit on that curve matters just as much as the interest rate you're paying. Almost every conversation about home loans is about the rate. Almost none of them are about the shape. And the shape is what decides how much of your life you spend paying for the money instead of the house. Make the phone call. Ask about the term. Check whether it's offset or redraw. 3 free things, and between them, they're worth more than most rate negotiations. If this changed how you see the loan, that's what this channel is for. The mechanism underneath the headline. Subscribe and I'll keep pulling them apart. And the usual. This is general information, not personal financial advice. Your loan, your circumstances, your call.